Hey, this is Adam and Kyle from ProjectionHub, where we help founders and business buyers create projections, business plans, and find and secure SBA loans. And today we are back to answer another burning question. Adam and I both come from a background in SBA lending, but Adam was an executive director of an SBA lender for over 12 years. And so I'm going to ask him the burning question and we will get his expert insight. And so today's burning question is, how do SBA lenders look at financial projections for an expansion project? So contextually, you're a business owner out there, you're looking to add on, expand, grow your business, you're gonna need some money to do that. How is the lender gonna be scrutinizing and kind of, I guess, underwriting that application?
Yeah, so a lot of times if you hear our videos, you'll hear us talk about debt service coverage ratio. Got to hit this debt service coverage ratio, which means you have enough cash flow from the business to be able to cover the debt payments. And the key thing that typically we say is that lender wants you to have a 1.25 debt service coverage ratio or above, meaning you've got $1.25 of earnings for every dollar of debt service. In an expansion, like let's say you are running an auto repair shop and you're looking to open a second one, right? So you're expanding the business. Well, it's probably pretty unlikely that your first auto repair shop is so profitable that it can cash flow maybe its own current debt plus the debt of the new location. And so that's where projections are going to have to come into play. We're going to have to say, well, obviously the new facility is going to provide some cash flow for us. And so, we're going to project that to be able to, demonstrate that debt service coverage ratio. So, that being said, the lender will still look at debt service coverage ratio from the prior years. And so, what I've heard from lenders is that they want to see a 0.6 debt service coverage ratio for the new proposal. And so, if you are expanding into the new location, they'll say, okay, you don't have to hit the 1.25 last year, but you need to hit at least 0.6 historically.
So I'm just trying to think about, we did a video recently where we were talking about like cash flow as it relates on a tax return versus like interim financials. So I'm kind of thinking about, if you're a business that is expanding, maybe you've strategically tried to include as many expenses as possible to reduce your taxable income. So maybe, that income on a tax return basis doesn't look super cash flow positive, but you still want the opportunity to expand the business. So, I'm thinking about this in terms of, like, if I was buying a business and we know that there's this process of like lender approved add backs based upon expenses or something that might go away, and that can be added back in to improve that cash flow and ultimately try to hit that debt service coverage ratio target. How does that process work for like an expansion business, where like strategically they're maybe doing the thing a business should to like reduce that taxable income, but they don't want that to like shoot them in the foot when they're trying to also grow the business, when that cash flow might be there, it just might not look like it on a tax return basis.
Yeah, I mean, there are add backs that are completely legitimate, like depreciation or owner's compensation. Like, let's say you're paying yourself a salary way more than you really need to earn because you can, or the business has cash flow. You can add back some of that salary. So there are add backs that make a lot of sense, and then there are the add backs that are like, we took a family vacation and I hopped over here for one day to a business conference or something, and I tried to count the whole thing as a business expense. Or I've got a luxury SUV as my business car, or what, like those things. um I'm not a tax accountant, I'm not the IRS either, so that's between you and you and the IRS. But probably a lender, from a lender's perspective, they're not going to go for those add backs. They're going to say, well, it's just, if you're doing that now and calling that a business expense, you don't get to then say, but next year it's not going to be a business expense anymore. It's, you can't have your cake and eat it too, as they say. So
So, but there is that part of the process. Like there is, like in the acquisition process, and you're trying to, there's a calculation of the seller's discretionary earnings, and then there's kind of a back and forth of trying to like get to the root of like what can actually be considered a cash flow improvement based upon that. That's also going to happen in the underwriting of an expansion project. Like there's going to be that process of like, okay, this is what the tax returns say, but really there's that case that like that process is still happening, even though it's all within the same business.
Yeah. So I'd say the big difference, I think IBEX would be treated differently between an acquisition or an existing business, because in an existing business, if you are the owner and you're trying to argue for an add back for your personal vehicle that you're calling a business expense, nothing is going to change next year. So the lender's going to say you're going to do the same thing. So no, we're not going to count that. If it's an acquisition and it's a new owner, the new owner does have the opportunity to say, hey, I don't know, this old owner, they were doing all these crazy things. We're not going to do those things. And so we're gonna report all of our cash sales on the tax return. We're gonna not do these expenses. We're not gonna do family vacations or pay all of our personal family cell phones or health insurance or whatever on the business. And the lender may go for that. But if it's the same ownership going forward, you're probably not going to get those add backs counted.
Right. So another question I have, we're just looking at an SBA lender that's assessing projections for an expansion project. A part of like a startup SBA loan or even an acquisition SBA loan is there's usually a percentage required by the owner of the business to like invest in that project, right? Because so I guess talk about a little bit how that looks for an expansion versus startups or an acquisition. What would be expected of the owner of the business?
Yeah. So typically for a startup or an acquisition, you're going to have a minimum of a 10% equity down payment. Risky industries or special use properties. There's all sorts of reasons that you might need more than 10% equity, but that's kind of the bare minimum. But on an expansion, that's not required. So you could get a loan. You got a new contract, you need a loan to support by fulfilling the contract. You could do 100. You have the possibility of doing 100% financing. And something that's cool is that you can do that with an acquisition as well in some unique scenarios if the business that you're acquiring is in the same industry. Specifically, I think it has to actually have the same NAICS code, the NAICS code. It's like the industry code on the tax return. So if your current business is using the same NAICS code as the business you're acquiring, then I think that SBA will allow you to treat that as an expansion. And in theory, you don't have to put any equity down for that. That may be the SBA take on it. And then again, any SBA lender may say, well, yeah, just because SBA says that, but we as a bank and our underwriters, we decide we still want you to put 10% down.
Right. Yeah, there's a difference between SBA policy and like lender or SBA like SOP and lender policy on like how they might want to what that percentage actually needs to be or, or what that might not be. But cool. That is another SBA burning question answered. So if you're out there and you are an owner of a business, you're considering an expansion, and you think you're going to need to finance that or you're thinking about SBA for a part of that, and you'd just like to get a little bit of kind of expert guidance, feel free to go down in the description below. We offer a free SBA expert review where you can tell us a little bit about yourself and your situation, and you can get Adam's kind of personalized feedback and guidance on, maybe how you would structure it or things to be aware of, or, kind of thinking about how you might want to approach that. If you have any direct questions, you can leave a comment down below or email us at support@projectionhub.com. Give it the video a thumbs up. Consider subscribing to the channel, and we will catch you on the next video. Thanks.